What if you've been blind your whole life, but not in the way you think? Not physically, financially. What if money, real wealth, has always been written around you in invisible ink? On the cereal box you choose every morning, in the sneakers that suddenly trend on TikTok, in the coffee shop that appears on every street corner like magic. What if you've been touching wealth every day, but never owned a single piece of it? Here's the shocking truth. Only 1 in 5 Americans can correctly explain what a stock is. Not what to buy, but what a stock actually is. And yet every year, people rush into Robinhood accounts, throw money into the market, and hope for a miracle. They're not investing. They're gambling in a game where they don't even know the rules. But Peter Lynch, one of the greatest investors in history, saw through the illusion. He believed you don't need a Wall Street suit, or a Harvard degree, or even a financial advisor to become wealthy. You just need to learn how to see. He didn't teach stock picking, he taught pattern recognition. He taught how to read the hidden story beneath your everyday life. The fast food lines, the overflowing carts at Costco, the empty shelves after a viral trend. Everything speaks if you know how to listen. In this video, we're not just going to teach you how to invest. That's surface level. We're going to decode the entire illusion. You'll learn to see capitalism not as a monster, but as a mirror. You'll learn to spot wealth where others see boredom. And you'll finally understand why the stock market isn't a game. It's a language written in invisible ink. And today, you'll learn how to read it. Chapter 1. The Secret Language of Rich People. You've heard people say, the rich play a different game. But the truth is even more disturbing. They speak a different language. Money isn't just dollars and cents. It's a dialect. A quiet whisper passed down in boardrooms, books, and bedtime stories you were never told. It's why 2 people can walk past the same building. One sees bricks, the other sees a billion-dollar rat. One sees a line outside Starbucks, the other sees recurring revenue. Here's the big idea. Money is a language, and unless you're fluent, you'll always be a servant to those who are. It's not about being smarter, it's about learning the code. Rich people aren't born better at math. They've just spent their lives absorbing how money talks, through real estate, businesses, stocks, and time. And if you weren't raised with that dialect, everything about wealth will feel confusing, even intimidating. Think about it like this. If someone handed you a letter written in ancient Latin and told you it held the secret to your freedom, you'd squint, nod, then fold it up and never read it. That's how most people treat the financial world. Stocks, bonds, profit margins. Sounds like another planet. So they passively hand over their money to a professional or avoid investing altogether. But Peter Lynch flipped that logic. He believed that regular people, yes, people like you, could decode that letter. And when you do, something strange happens. The fog lifts. The system doesn't feel so rigged anymore. You realize the game isn't unfair. It's just unwritten. Story time. In the 1980s, Peter Lynch ran the Magellan Fund. While analysts were buried in spreadsheets, Peter would walk through malls. He noticed which stores had full dressing rooms. He watched teenagers swarm Foot Locker. He once picked a stock based on his wife's favorite pantyhose brand because she said they were flying off the shelves. That one decision made millions. No crystal ball, just pattern recognition, just reading the ink the rest of the world ignored. That's the real secret. The rich don't wait for CNBC to tell them what's hot. They already see it, months ahead, because they've trained their eyes to listen. They see trends at gas stations. They hear market signals and TikTok fads. They spot supply chains hidden inside Amazon boxes. And once you begin to see that way, the world stops being noisy. It becomes readable. Have you ever felt like everyone else knew something you didn't? Like they were playing a game with rules whispered behind your back? What if from today on, you started hearing those whispers? What if every time you spent $1, you asked, where does this money actually go? Who owns this company? Could I own a piece too? Because once you ask those questions, the ink begins to glow. But this is just the beginning. Because if money is a language, then the world is a textbook. And some of its most valuable lessons are hiding right beneath your feet. Chapter 2. The Business Under Your Feet. Every street you walk on is paved not just with asphalt, but with ambition. Look around. The cafe on the corner, the billboard overhead, the rideshare pulling up beside you. Every one of them was once just an idea. Someone said, what if? And then risked everything to build it. The sidewalk beneath you isn't just infrastructure. It's a timeline of businesses that succeeded, failed, or evolved. And yet most people never stop to ask, how did all this get here? The big idea is this: business is not a faraway Wall Street game, it's the very fabric of your world. You don't live in a government-run machine, you live inside a marketplace. From the moment you wake up and check your iPhone, Apple Inc., sip your Starbucks, SBUX, and scroll through TikTok, owned by ByteDance with implications for digital ad stocks, you are engaging in a daily ritual of business. You are walking through someone else's income statement. And unless you understand that, unless you see the economy as a living organism, you'll always feel like a cog, never a creator. Peter Lynch believed the biggest mistake people make is assuming business is complicated. It's not. It's incredibly simple. It's this: find something people want, deliver it better than anyone else, make a profit, that's it. That's what Henry Ford did with cars, what the Wright brothers did with air, what Elon Musk did with batteries and branding. And it's what millions of quiet, unknown entrepreneurs are doing in your city right now, selling soap, renting tools, building apps, printing t-shirts. If you know how to spot them early, you're not just a consumer, you're an owner. Let's go back. In the early days of America, business wasn't taught in schools. It was the school. Immigrants started corner shops. Railroad tycoons connected cities. Entrepreneurs like Andrew Carnegie and Cornelius Vanderbilt didn't just make money, they made infrastructure. These weren't Ivy League geniuses. They were obsessive learners, and they understood something most people forget. Wealth isn't about having money. It's about controlling the systems that produce it. You might think, but I'm just one person. Exactly. So was Sam Walton before he opened his first Walmart. So was Sarah Blakely before Spanx. The business under your feet, the entire economy, isn't built by titans. It's built by people who see opportunity where others see normal life. Lynch encouraged his readers to walk around their towns and ask, what's everyone buying? What's always crowded? What just opened and already has buzz? These aren't investment tips. They're x-rays of the market. And here's the twist. When you start seeing business like this, you no longer fear recessions. You start spotting opportunity in decline. You recognize patterns others overlook. You become a translator of the economy, and every great investor, Warren Buffett, Cathie Wood, even the new wave of YouTube-era traders, they all learned to see beyond the numbers. They saw businesses as living stories. So ask yourself, what's beneath your feet? Not just concrete, not just shops, but decades of trial, error, invention, failure, and rebirth. A city is a living portfolio, and you've been walking through it blind. Until now. Because next, we'll dive into how a single hamburger changed the world, and how recognizing that pattern could change your financial future. Chapter 3. The Hamburger That Built an Empire. One hamburger, that's all it took. Not the taste, not the sauce, but the system. A simple patty, replicated thousands of times a day with ruthless consistency, turned a roadside diner into a global empire. The story of McDonald's isn't just about fast food. It's the blueprint for how an ordinary idea, executed extraordinarily well, can become one of the greatest wealth machines in human history. The big idea here is this: great businesses don't have to be complicated, they just have to scale. McDonald's didn't invent the hamburger, it perfected the process. It didn't make the best food, it made food predictable, fast, cheap, uniform. And that predictability created a franchise model so powerful that by the time you were born, the Golden Arches were more recognized than the Christian Cross. Peter Lynch was obsessed with this kind of pattern. He looked for businesses that could repeat success like a machine. During his walk through the mall investing days, he paid close attention to companies like McDonald's, not because of what they sold, but how they sold it. A brand that turns food into routine becomes a cash flow engine. And if that brand embeds into the culture, birthdays, road trips, late-night cravings, it becomes nearly immortal. Now enter the story. The year is 1954. A milkshake machine salesman named Ray Kroc visits a small hamburger stand run by the McDonald brothers. He sees something unusual: efficiency, orders flying out, customers happy, a kitchen built like an assembly line. Kroc doesn't just see burgers, he sees a formula, a replicable blueprint, and he asks the question that changes everything: why isn't this everywhere? Kroc partners with the brothers, franchising the model nationwide. But here's the twist. McDonald's doesn't make most of its money from hamburgers. It makes money from real estate. Every franchise pays rent. Every location is a cash-flowing property. They sell food, but they own the land beneath it. That dual income stream, real estate plus business, makes McDonald's a financial juggernaut. What does this mean for you? It means you don't need to chase the next big thing. Sometimes wealth hides in what's already obvious, but overlooked. While others chase NFTs or biotech, you might spot the next McDonald's in a crowded bubble tea shop, or a gym franchise growing like wildfire. Ask, is the system repeatable? Is the product addictive? Does the brand expand without heavy lifting? You don't have to invent a better hamburger. You just have to recognize the next one before everyone else. Have you ever seen a business in your neighborhood explode with popularity and thought, damn, I should have invested in that? What if the only thing stopping you from that moment again is your ability to pay attention? Because once you train your eye, those ordinary hamburgers start glowing with invisible ink. And that brings us to the next critical illusion. Why what you see in the stock market often has nothing to do with what the business is actually worth. Chapter 4. The stock is not the company. Here's the trap. You see a stock price crash 30% in a week, and your brain screams, this company is dying. Or it skyrockets 200% in a month, and you think, I'm missing out on the next Tesla. But here's the truth. Peter Lynch spent his life shouting into the void. The stock is not the company. Let that land. A stock is a reflection, often distorted, sometimes delusional. It doesn't represent a company's soul. It represents the world's mood about that company in a moment, and moods lie. The big idea is this. Stock prices are stories. But not all stories are true. Sometimes they're panic-fueled hallucinations. Other times they're hype-soaked dreams. What matters is the business underneath, because that's what endures when the price jumps off a cliff or rides a rocket. Let's rewind to the year 2000. During the dot-com boom, companies with no revenue, no product, and no customers were worth billions, on paper. Pets.com had a sock puppet mascot, tons of ads, and stocks soaring through the roof. But behind the curtain, no sustainable model. Within months, it collapsed. Meanwhile, quietly in the shadows, Amazon, yes, that Amazon, was building warehouses, optimizing logistics, bleeding cash to gain market share. Its stock crashed too, but the business kept growing. Today, one is a case study in hype. The other is history. Peter Lynch ignored the noise. He didn't ask, what's the stock doing? He asked, what's the company doing? Are they making money? Are customers loyal? Are products flying off shelves? If so, the price could be temporarily wrong, but the value was intact, and over time, value always wins. Think of it like this. Imagine you're buying a house. You wouldn't care what it sold for yesterday or what Zillow says it's worth today. You'd look at the roof, the foundation, the neighborhood, the rental income. You'd ask, is this a good house? Not, is this a hyped house? The same applies to stocks. When you buy a share of Apple or Nike, you're not buying pixels on a screen. You're buying a piece of that company's reality. Its customers, its supply chain, its IP, its potential. The stock price is just a temporary opinion, but the business is a long-term truth. And yet, most people never ask the right questions. They obsess over charts, over analyst upgrades, over headlines, but none of that changes what's actually happening inside the business. They're mistaking the mirror for the man. So ask yourself, have you ever panicked when a stock dropped, even though the company was fine? Or chased a rising stock without knowing what it even did? That's not investing. That's reacting. What if, from today forward, you stopped reacting and started evaluating? Because once you learn to separate the stock from the story, you begin to see what's real. And speaking of reality, there's one force in finance more real, more magical, and more invisible than anything else. It's slow, boring, and it's quietly building fortunes behind your back. It's time to meet compounding. Chapter 5. The Secret Life of Compounding. It doesn't roar. It doesn't spike. It doesn't go viral. In fact, it's almost boring until it isn't. It's the slowest magician in finance, the silent architect behind nearly every massive fortune you've ever heard of. Einstein allegedly called it the eighth wonder of the world, and yet most people ignore it entirely. Its name? Compounding. Here's the big idea. Compounding is not about growing fast. It's about growing relentlessly. It's the power of earning interest on your interest. Not once, not twice, but continuously. Like a snowball rolling down a hill, picking up more snow, gaining more surface area, and building more momentum as it moves. The longer it rolls, the bigger it gets. And the secret isn't speed, it's time. Let's look at Warren Buffett. By age 30, he was already a millionaire. But what's more shocking is that 95% of his net worth came after the age of 60. Not because he suddenly became better at investing, but because he stayed in the game. His wealth wasn't the result of a magical strategy. It was the result of never interrupting compounding, never selling out too early, never jumping ship for the next big thing, just letting the snowball roll. Peter Lynch understood this too. During his years managing the Magellan Fund, he didn't just look for 10-baggers, stocks that went up 10x. He looked for companies that could quietly compound earnings year after year. No drama, just results. And when investors panicked and sold during temporary downturns, Lynch held or bought more, because he wasn't chasing headlines. He was chasing time. Let me tell you a story. Imagine two friends, Alex and Jordan. Alex starts investing $200 a month at age 20 and stops at 30. Jordan starts at 30 and invests the same $200 every month until age 60. Guess who ends up with more money? Alex. Why? Because of the early compounding window. Those first 10 years, though short, had more time to grow. Jordan invested for 3 times longer, but started too late. The magic isn't how much you invest. It's how long your money is allowed to work. But here's the danger. Compounding is fragile. One bad habit can kill it. Selling during a dip, dipping into your investment early, chasing hype and forgetting fundamentals. All these things reset the snowball. You start over at the top of the hill, every single time. Have you ever checked your bank account and thought, why is nothing changing? Maybe the problem isn't how much you make, but how quickly you interrupt what's trying to grow. What if, instead of hunting windfalls, you protected your compounding like a sacred fire? Because the truth is, wealth isn't built by explosive wins. It's built by patience, discipline, and time. And once you start seeing that, you stop chasing fireworks and start planting forests. But compounding's power becomes even more dangerous or more profitable when you realize this. You've been investing all along. You just didn't know it. Every dollar you spend is a clue. Every brand you buy into is a vote. And next, we'll show you how your everyday life has been screaming investment advice at you for years. Chapter 6. You've been shopping for stocks your whole life. You think you're just buying shampoo or shoes or a sandwich. But what if every purchase you've ever made was actually a stock tip? What if your grocery cart, your streaming subscriptions, your daily habits were flashing signals from the market itself? Here's the big idea. You're not just a consumer. You're an analyst in disguise. You've been doing research for years. You just didn't realize it. Every time you return to the same brand, tell a friend about a new app, stand in a long line at a packed store, you're experiencing demand. You're witnessing a business succeeding before the stock chart even reacts. That's not noise. That's insight. Peter Lynch built an empire on this exact principle. He didn't hide in spreadsheets or wait for Wall Street memos. He watched his wife shop. He listened to his kids rave about new products. He strolled through malls, not for fashion, but for data. If his daughter said a brand was everywhere, he'd check it out. And often, he'd invest, not because of a technical indicator, but because of something far better, real-world traction. Here's a real story. Back in the 1990s, Lynch's family couldn't stop talking about Legs pantyhose. Every store they went to was sold out. Women were buying multiple pairs. The packaging was unique. The product had momentum. So Lynch looked at the stock behind it, and it was flying under the radar. He bought it. It soared. Now imagine your own life. What brands are your friends obsessed with? What apps do your coworkers use daily? What store just opened near you and is always packed? That's not random. That's early access, and you didn't need an MBA to notice it. Think of it like this. The stock market isn't just charts and codes. It's a reflection of culture. And culture starts in living rooms, classrooms, and checkout lines long before it reaches CNBC. If you can pay attention, you can get ahead. But most people miss it. Why? Because they separate life from investing. They believe research happens in a boardroom, not a bowling alley. But if you eat Chipotle 3 times a week and they've got a line out the door every time, you just performed market research. If you see your teenage brother obsessed with a new game before it trends on Twitch, you just found a momentum stock in the making. Have you ever discovered something cool and thought, this is going to be huge, but didn't invest because you didn't think it counted? What if from now on, you gave your instincts permission to lead? What if the next time you reached for a product, you also checked if it was a publicly traded company? Because you've been training your whole life. Now it's time to listen to what your habits have been trying to tell you. But observation is just the beginning, because up ahead, you'll learn how to not just spot opportunity, but to understand the revolutions that rewrite the rules entirely, the kind that don't whisper, they roar. Chapter 7. The Railroad, the Car, and the Code. Every few generations, something seismic shakes the world, not with an earthquake, but with an idea. It rewires how we live, what we value, and where money flows. These aren't trends, they're revolutions. And if you learn to recognize their pattern early, you don't just witness history, you profit from it. The big idea: massive wealth is created when technology meets timing, and you notice before the headlines do. Peter Lynch didn't wait for Wall Street to tell him what was next. He looked backward to predict forward, because history doesn't repeat. But it rhymes. Let's go back to the 1800s. The railroad changed everything. Suddenly, goods and people could move faster than ever before. Towns near tracks exploded. Entire industries, coal, steel, timber, were born just to support the new infrastructure. Early investors who saw the railroad not as a fad, but as a framework, became legends. Fast forward to the early 1900s, the automobile arrives. Ford's Model T wasn't just a car. It was freedom on wheels. But the real money wasn't just in Ford stock. It was in the ecosystem. Gas stations, tires, highways, malls, motels. The car didn't just move people, it moved capital across the country. And those who understood that weren't just driving, they were compounding. Now think about the 1990s, the internet. At first, it felt abstract, technical, nerdy. But the people who realized it would change everything, from shopping to dating to communication, got in early. Amazon sold books, then it sold everything. Google organized the web, then it organized your entire life. The code became culture, and today, the next revolutions are already whispering. AI isn't a sci-fi fantasy, it's reshaping industries in real time. Platforms like ChatGPT, Midjourney, and 11 Labs aren't just tools, they're infrastructure for the next wave of business. And like the car or the code, the real money might not be in the front-facing brands, but in the picks and shovels, the chips, the cloud storage, the energy powering it all. So, how do you spot a revolution early? You listen for friction. What's slow, broken, or frustrating in your life? That's the birthplace of innovation. You observe obsession. What's stealing hours from people without them noticing? That's product market fit. And you study ecosystems. What has to be built around this new thing for it to survive? Have you ever looked at something, Uber, Spotify, TikTok, and thought, how did I miss that? You didn't. You were probably already using it. You just didn't realize usage is data. Adoption is signal. So, the question is, are you walking through another revolution right now? Are the rails being laid under your feet? Is the code being written behind your eyes? Because if you're paying attention, the next Amazon might already be blinking in your daily habits. But spotting revolutions is only half the battle. Up next, you'll need to shift your identity, because until now, you've been acting like a spectator. It's time to become an owner. Chapter 8. Stocks, tickers, or ownership. You check your app. The line is red. Your heart sinks. You feel like you've lost something, money, maybe even intelligence. That's the trap most investors fall into. They see a stock as a game score, a number blinking up or down, a roller coaster of dopamine and dread. But Peter Lynch would shake his head and say, you're not buying a number, you're buying a piece of a business. The big idea is this: stocks aren't bets, they're ownership. And until you think like an owner, you'll always act like a gambler. When you buy a share of a company, you're not placing a chip on a roulette table. You're becoming a partner in someone's vision. You own the brand, the product, the employees, the patents, the cash flow. You own a slice of everything that makes that business real. But here's the problem. Apps today gamify investing. Green confetti when you buy, fire emojis when it spikes, push notifications like slot machines. They turn shareholders into speculators, people who chase motion instead of meaning. That's not investing. That's being emotionally hijacked by software designed to keep you addicted, not informed. Let's take a different approach. Imagine you're offered the chance to buy 10% of your friend's bakery. She shows you her books. The muffins are flying off the shelves. She's hiring. She's expanding. Would you ask her for a chart of the weekly muffin demand curve before you decide? Or would you simply say, I believe in this. I see the growth. I want in. That's ownership. That's investing. Now apply it to the market. When you buy a share of Starbucks, you're not just buying stock code SBX. You're buying millions of daily coffee rituals, global brand power, real estate dominance, loyal customers. That's ownership. But if you only look at the 7-day price graph, you've missed the point. Peter Lynch urged investors to ask a simple question. If I could own the whole company, would I? That flips the script. You stop asking if the price is going up and start asking if the business is strong. You care less about noise and more about narrative. And that mindset protects you in downturns because you don't panic sell a business you believe in. Ownership also changes your relationship with risk. Instead of trying to predict the next spike, you focus on durability. Will people still need this in 5 years? Will this company survive a recession? Is it solving a real problem or just chasing hype? Have you ever sold a stock because it dropped, only to see it rebound weeks later? That's the sign of a spectator. What if, from now on, you acted like the business was yours? What if every share you bought came with a front row seat at the boardroom table? Because when you make that shift from watcher to owner, investing stops feeling like chaos, and ownership sets you up for the next lesson. Because once you know what to invest in, you must learn why nobody taught you this in school, and why that silence was never an accident. Chapter 9, The Stuff They Don't Teach in School. You sat through algebra, memorized the mitochondria, recited the Pythagorean theorem, but nobody taught you how a credit card works, or why interest compounds against you just as powerfully as it can work for you, or that a 680 credit score could quietly cost you 6 figures over a lifetime. Why? Here's the big idea. Financial ignorance isn't a bug in the system, it's a feature. Because when people don't understand money, they stay dependent on jobs, on banks, on government programs, on short-term solutions. The less you know, the more you're controlled. Peter Lynch never said this explicitly, but his work screams it. Knowledge is the only real antidote to financial slavery. Let's talk truth. In most schools, students graduate knowing how to dissect a frog, but not how to budget for rent. They can quote Shakespeare, but not explain what a 401k does. Why are we trained to be obedient employees, but never curious owners? There's a term for this: learned financial helplessness. It's the quiet epidemic no one's talking about, and it's why millions of young adults fall into traps. Buy now, pay later schemes, minimum payments, subscription bloat, debt cycles that feel like cement shoes. Not because they're irresponsible, but because no one ever gave them the manual. Peter Lynch knew that most great investors didn't start with wealth. They started with awareness. They didn't wait for someone to teach them. They realized no one would. And that realization became a trigger, not for panic, but for power. When you realize the game won't teach you the rules, you have 2 choices: blame it or learn anyway. Let me give you a picture. Imagine 2 students. One learns that putting 100 month into an index fund from age 18 to 30 could yield nearly $150,000 by retirement without lifting a finger afterward. The other racks up student loans, buys $6 lattes, and ignores their 401k until age 40. Same intelligence, different exposure. And that exposure makes all the difference. So, let's break the silence right now. Understand this. Interest is either a wealth machine or a thief, depending on who controls it. Credit cards are not evil, but ignorance about them is. Debt isn't the problem. It's invisible debt that buries people. Money isn't emotional, but your lack of education makes it feel terrifying. Have you ever stared at a paycheck and wondered, why does it feel like I'm always behind? It's not just cost of living, it's cost of not knowing. What if from this moment forward, you made yourself a promise? No more waiting to be taught. You will learn the game. You will ask the uncomfortable questions. You will stop outsourcing your power to a system that benefits from your confusion. Because when you step out of the fog, you realize something shocking. Financial education is not just about making money. It's about reclaiming autonomy. And that autonomy starts with seeing businesses differently. Not as cold corporations, but as solvable mysteries. And up next, we'll show you how to become the detective that finds them. Chapter 10. How to pick a business like a detective. Imagine a detective walking into a crime scene. He doesn't see blood, he sees clues. He notices the scuff mark on the floor, the coffee mug still warm, the window slightly ajar. Where others see chaos, he sees a story. Now, imagine walking into a business, not as a shopper, but as an investigator. You don't just look at products, you observe patterns. You don't just see sales, you analyze behavior. And suddenly, investing stops being a guessing game. Here's the big idea. The best investors think like detectives. They look past what's obvious and dig for what's true. Peter Lynch didn't search for hot tips. He searched for small clues that others ignored. Inventory turnover, expanding store footprints, customer loyalty, word-of-mouth buzz. To him, a rising stock wasn't a surprise. It was the punchline to a mystery he had already solved. Let's say you walk into a new retail store in your city. It's packed. The staff is sharp. The prices aren't cheap, but people are still buying. You visit again next month, still busy. Then a second location opens. Same experience. The customers aren't just buying, they're returning. That's a clue. Something is working, and if that company is public or about to be, you're ahead of the curve. Story time. There was a small company in the 80s called The Limited. They sold fashion for young women. Peter Lynch noticed it had short lines, rapid product turnover, and loyal customers. He studied the management, reviewed the balance sheet, and saw a low debt load with expanding margins. Nobody on Wall Street was watching it. He bought in. It became a multi-billion-dollar success. You don't need to be a financial wizard to find those clues. You need curiosity and a checklist. Ask, are customers obsessed or indifferent? Is the business expanding naturally or just hyping growth? Are margins getting better over time? Is the founder still involved or did they cash out? Is this solving a real pain or just a passing trend? When you treat business like a puzzle, investing becomes active, not passive, not reactive. You become a thinker, not a gambler. And the best part, clues are everywhere. In Yelp reviews, in store layouts, in the way employees talk about their jobs, in how fast your order arrives. Real business health leaks through the cracks. But here's the catch. Most people don't slow down long enough to notice. They chase signals from Twitter. Buy because someone on YouTube feels good about it. But they never visit the business, never check the product, never interview a customer. They're solving a mystery without entering the room. Have you ever regretted not acting on a company you knew was exploding? The gym chain your friends kept raving about? The app your niece wouldn't stop using? What if from now on, you pulled out a notepad and asked, what is this telling me? Because clues aren't just scattered, they're screaming. And when you start listening like a detective, the world of investing stops feeling like a gamble. But here's the twist. Even with all the right clues, Wall Street still wants to fool you. And in the next chapter, we'll expose the myth they built and why it's time to burn it down. Chapter 11, Wall Street's favorite lie. They call it the market, as if it's a single, living, breathing oracle of truth, as if its every rise and fall is gospel. But here's the uncomfortable truth Peter Lynch pulled the curtain back on. There is no such thing as the market. It's a myth, a mirage, a psychological trap designed to manipulate your emotions and rob your attention. Here's the big idea. The market isn't real. It's just a mood swing machine, powered by fear, greed, and noise. And when you make decisions based on its erratic movements, you stop being an investor and start being a puppet. Think about it. When someone says the market is down 500 points, what does that actually mean? Are all companies collapsing? Are all businesses failing simultaneously? Of course not. Somewhere, someone's growing, someone's innovating, someone's selling out every product on their shelf. But the headlines don't tell you that. They just lump everything into one terrifying narrative. Peter Lynch hated this mindset. He often said, far more money has been lost preparing for market corrections than in the corrections themselves. Why? Because people make terrible decisions when they treat the market like a monster. They sell everything when prices dip. They buy wildly when prices rise. They forget they own businesses, not blips. Let's go back. In 1987, the Dow Jones plunged over 20% in a single day, Black Monday. Panic set in. News anchors declared financial apocalypse. But Lynch held firm. Why? Because the companies he owned were still selling products. still earning profits, still growing. The price didn't reflect reality. It reflected panic. And months later, most of those stocks recovered. Now, zoom forward to 2020. COVID crashes the market. Airline stocks nosedive. But quietly, businesses like Zoom, Shopify, and Peloton soar. The market fell. But opportunity rose, if you knew where to look. Here's the trap. Wall Street wants you to think in indexes, in averages, in macro drama. Because if you believe everything rises and falls together, you'll feel helpless. And helpless investors are dependent investors. They pay fees, they chase advice, they follow the herd. But smart investors, Lynch-style investors, ignore the market. They study companies, they look for mispriced value, they see opportunity and volatility. When everyone else is screaming, sell, they're asking, is the business still sound? Because that's all that matters. So, here's your wake-up call. The market is not your boss, it's not your enemy. It's not even real. It's a mood ring worn by millions of strangers. And just like moods, it passes. Have you ever sold out of fear, only to regret it later? Or hesitated to buy because the market felt risky? That's not strategy, that's superstition. What if, from now on, you broke up with the market? What if you stopped checking it like a toxic ex? Because once you stop reacting to shadows, you start seeing real light. And up next, we'll teach you how to ride the waves, not predict them. Because timing the market is impossible. But surfing it, that's a skill you can master. Chapter 12. You can't time the wave, but you can ride it. Everyone wants to be early, to catch the next Tesla, the next Netflix, the next wave before it rises. But trying to time the market is like trying to surf a tsunami from satellite images. You can't predict the wave, but you can learn how to ride it once it hits. The big idea is this. You don't have to predict the future. You just have to recognize momentum early and hold on long enough to benefit. Peter Lynch never tried to time tops or bottoms. He didn't obsess over perfect entries or flawless exits. He looked for real businesses, showing real signs of growth, and he rode the wave. Sometimes the board wobbled, sometimes it dipped, but he never jumped off because the water got choppy. Here's the truth. Wall Street won't tell you. Most people who try to time the market lose. Why? Because they're not responding to signals. They're reacting to emotion. Greed whispers, buy now or miss out. Fear screams, sell before it crashes. And so, they jump in too late and jump out too early. Let's go to a true story. In the early 2000s, Apple was trading at a few dollars per share. The iPod had just launched. Most people thought it was a niche toy. But the early wave riders, they saw something different. Momentum. Fans were becoming evangelists. Sales were accelerating. The brand was shifting. Those who rode that wave, not predicted it, but recognized it mid-curve, made fortunes. That's the surfer's secret. You don't need to catch the very beginning. You just need to learn what a good wave looks like. You need to paddle when it's forming. You need to ride it while others hesitate. And you need to stay on when the water gets rough, because it always does. Peter Lynch often said, the key to making money in stocks is not to get scared out of them. And that's the surfer's mindset. You don't jump off at the first ripple. You lean in. You adjust your balance. You trust the board. Here's how to spot a surfable trend. Is the business growing organically or just hyping press? Are customers staying longer and spending more? Is the product becoming a habit, not a novelty? Is there room to grow, new markets, new users, new geographies? And here's the key. Once you're riding, don't obsess over the price every day. Surfers don't stare at their feet. They read the rhythm. They flow with the wave. Have you ever jumped into a stock only to panic at the first dip and sell at a loss? That's trying to control the ocean. What if, from now on, you stopped pretending to predict and started practicing presence? What if you learned to recognize, ride, and hold? Because waves come. Always. You just have to know when one is building. And once you're riding, you'll need a compass. A single powerful question to know if the business underneath is truly worth holding. That's what we'll explore next. Chapter 13. Ask this one question. In a world drowning in data, P/E ratios, debt to equity, quarterly earnings, analyst upgrades, Peter Lynch boiled it all down to something so simple, it almost felt like cheating. Before buying any stock, he asked, if this business shut down tomorrow, would anyone care? Here's the big idea. A great business isn't just profitable, it's needed. It's part of people's lives, part of their routines, their identities, their choices. And that stickiness is what creates staying power in the market. A good product creates a transaction, a great product creates a habit, and a legendary product creates a relationship. Let's break it down. You walk past 3 stores, one selling novelty mugs, one selling high-end headphones, and one packed with people buying coffee. Which one feels essential? Which one could you imagine someone driving across town for, even during a recession? That's the one Lynch would circle. Think about it. If Amazon disappeared tonight, the world would notice. If Coca-Cola vanished, billions of people would feel the absence. If Netflix suddenly went dark, families, couples, and dorm rooms would all search for the remote in horror. That emotional dependency, that inertia, is the real moat around a business. Now, picture this. You're evaluating a company you're thinking of investing in. It has decent financials, moderate growth. But you ask yourself the Lynch question. You imagine it vanishing. Do customers scream? Do competitors cheer? Does anyone blink? That gut check is more honest than any spreadsheet. Here's a real-world case. Decades ago, Lynch invested in Taco Bell. Why? Because every location he passed was slammed. The food wasn't gourmet, but it was fast, cheap, and addictive. If Taco Bell disappeared, millions of late-night college students, truckers, and budget-conscious families would miss it. That's stickiness, and stickiness scales. You can apply this test anywhere, whether it's a brand, an app, a service, or even a new trend. If you saw it vanish and life just moved on, that's not ownership. That's speculation. But if pulling it out of culture feels like pulling oxygen from a room, that's a business worth holding. And you don't need financial models to spot this. You just need awareness. Start asking. Do people love this or just like it? Are they loyal or just curious? Does it create delight or just utility? Would I care if this company died tomorrow? Have you ever felt emotional about a brand? The way your sneakers feel? The way your favorite software just works? That's not random. That's what real investors seek. Not hype, not noise, but connection. What if from now on you stopped asking, is this stock going up? And started asking, would people suffer if it went away? Because that one question slices through complexity. And once you find a business worth owning, the next step is personal. You don't just learn it, you live it. Coming up, your very first $100 investment. How to make it, how to frame it, and how to feel it. Chapter 14, your first $100 investment. There's something sacred about your first $100. It's not the amount, it's the meaning. It's the moment you stop spectating and start participating. The moment money stops being abstract and starts becoming a tool. And most importantly, it's the first time you say, I own this. Here's the big idea. Your first investment isn't about making a fortune. It's about building a new identity. You're no longer just someone who consumes. You're someone who participates in the system. You've gone from watching the game to owning part of the stadium. Let's walk through it. You've done the research. Maybe it's a brand you love, one you see everywhere, one your friends use, one you personally believe in. You're not chasing a trend. You're choosing a business. And now you decide, I'll put in $100. That's dinner for 2, a pair of sneakers, 2 weeks of coffee runs. But now that $100 becomes ownership. You tap buy. You refresh your portfolio. It's there, your first share. Nothing explodes, confetti doesn't rain from the sky, but something inside clicks. Suddenly, you care. You read news differently. You notice competitors. You track earnings dates. You walk into the company's store and think, I'm part of this. That emotional shift, it's everything. Let's take a real example. In 2012, Starbucks was trading at $11 a share, split adjusted. A high school student who loved the brand bought 2 shares with savings from a summer job, just 20. He forgot about them. A decade later, those shares had nearly tripled and paid dividends. But even more important, that investment sparked curiosity. He started reading books, studying other businesses, building a portfolio. That $22 became a lifetime of financial literacy. That's the power of your first $100, not in profit, but in transformation. Peter Lynch knew this. He encouraged everyday people to invest in what they already understood, not because it's safe, but because it creates clarity. The businesses you interact with daily are often the ones you can evaluate best. And once you invest, even a little, your brain flips. You go from passive to active, from how much does this cost me to how much could this make me? And here's the kicker. It's not about getting rich quick. Your first $100 might not double overnight. It might even dip, but you've now lit the flame. You've entered the arena, and every dollar after that becomes easier. Have you ever told yourself, I'll invest when I have more money? What if the truth is, you'll only have more money once you start investing? What if that $100 isn't a financial step, but a psychological shift? Because once you make it, the market doesn't look the same. You're no longer an outsider, you're in. But ownership also comes with responsibility. The next chapter will reveal how to tell when it's time to double down, or walk away. Because knowing when to buy is important, but knowing when to exit, that's where legends are made. Chapter 15, When to Buy, When to Run. You fell in love with the brand, you believed in the business, you bought the stock, and now the price is falling. Or maybe it doubled and your hands are shaking. Should you sell? Should you buy more? Should you hold? The silence of uncertainty is loud. This is the moment that separates investors from emotional hostages. Here's the big idea. Buying a stock is easy. Selling or holding is where your discipline gets tested. And Peter Lynch had a rule so simple, it feels like magic. Know what you own and know why you own it. That's it. If that reason disappears, you run. If it stays, you hold, even through storms. Let's unpack that. Most people think the goal is to buy low and sell high. But in truth, the real question is, has the story changed? Not the price. The story. Because prices lie. Stories, when true, don't. Imagine you bought a bakery stock because they were expanding in 20 cities. But a year later, their stores are closing. Management is changing weekly. Customers are leaving. That is a change story. That's a signal to reevaluate, maybe exit, now reverse it. You buy into a tech company, the price drops 30%. But the product is still growing. The user base is expanding. They're entering new markets. The story is intact, maybe even stronger. That's not a reason to panic. That's a reason to buy more. Let's go real. In the early 2000s, Netflix was mocked. Mail-order DVDs, what a joke. The stock dipped hard after initial enthusiasm. But their subscriber base kept growing. They kept innovating. Peter Lynch-style thinkers saw the underlying strength and held, or added. And that patience, it turned into generational wealth. Here's a trick. Write down your reason for buying before you buy. Literally, pen to paper. I'm buying this because... If the core reason later disappears, exit. No emotion, no regret, just logic. But if you never had a reason, you're not investing, you're reacting. Another Lynchism. A stock does not know you own it. It doesn't care about your feelings. It doesn't owe you a win. And it doesn't reward panic. It rewards understanding. The market punishes noise, but it rewards those who tune in to business fundamentals and tune out the crowd. So, how do you know when to run? Ask, has the management lost control? Are they abandoning the core mission? Has the competitive edge vanished? Are customers fleeing, not complaining, but leaving? If the answer's yes, don't hesitate. Walk. If not, stay. Or buy more. Great businesses fluctuate before they flourish. Have you ever sold a stock only to watch it triple later? Or held on to a disaster because you didn't want to admit you were wrong? That's emotional investing. What if from now on, you replaced emotion with story? Because when the narrative holds, you hold. When it breaks, you don't just react, you respond. But there's one more trap ahead. It's not the stock, it's not the company, it's the system around it, the hidden predators eating your gains from the inside out. And you'll meet them in the next chapter. Chapter 16, The Jungle of Fees and Fakery. You made the right call. You spotted the business early. You held through the dip. The stock went up. But somehow, your gains feel smaller than they should. You check your account, and there it is, the fine print. Fees, management charges, transaction costs. Layer after invisible layer peeling away your profits like termites in a wooden house. Here's the big idea. It's not just what you invest in. It's what eats at your investment behind your back. Wall Street is brilliant at creating products that look helpful, but quietly siphon your returns. They dress up mediocrity and complex jargon, slap on a glossy brochure, and take a bite of your wealth every single month. Peter Lynch warned about this constantly. He said, "The simpler the product, the better." If you don't understand how your investment works in under 5 minutes, it's probably not designed for you to win. Let's talk about mutual funds. Many promise high returns, but hide enormous expense ratios. These fees might seem small, 1%, 2%, but over decades they compound against you. That 1% fee on a $100,000 portfolio could cost you tens of thousands over a lifetime. You do the work, they take the cut. Then come the advisors. Some are brilliant, worth every penny, but others, they're just glorified salespeople, paid not to grow your wealth, but to steer you into products that kick back juicy commissions. Ever heard of front-end loads, back-end loads, hidden surrender charges? Welcome to the jungle. And don't forget trading apps. They say zero commissions, but they profit by selling your trades to high-frequency firms. You think you're saving money, but you're paying in price execution slippage, or worse, getting manipulated by algorithmic sharks front-running your moves. Even index funds, once the holy grail of low-fee investing, are being repackaged. Now there's an ETF for everything. AI cloud ESG growth momentum with a side of vegan tacos. And each comes with new layers of marketing, fees, and fluff. Don't fall for shiny. Fall for efficient. Here's your armor. Always check the expense ratio. Under 0.2% is ideal. Understand how your advisor gets paid. Ask bluntly, are you fee-only or commission-based? If you're in a fund, look at turnover rate, how often they trade. High turnover, higher hidden costs. Watch out for frequent traders in disguise. If you're being encouraged to move in and out constantly, someone is profiting, probably not you. Have you ever felt confused by your own investment account? Like there are charges you can't explain? What if, from now on, you decided you must understand every part of where your money goes, or it doesn't go there, because protecting your returns is just as important as earning them. And once you've cleared the jungle, it's time to turn your focus inward, because the way you spend might be telling a deeper story about the way you'll invest. Up next, the mirror you didn't know you were looking into, your own wallet. Chapter 17, the money mirror. Open your banking app, scroll through your transactions. What do you see? Coffee, food delivery, streaming subscriptions, random online orders you don't even remember making. Most people think their spending is a list, but if you look closer, it's something far more powerful, a mirror, because how you spend is how you think, how you feel, how you decide, and in many cases, how you sabotage your future. Here's the big idea. Your spending habits are the clearest reflection of your internal beliefs about money, not what you say you value, what you actually value. Peter Lynch didn't just invest by studying businesses, he observed human behavior. And there's no richer behavioral data set than a credit card statement. Think about this. 2 people each make $5,000 a month. One saves $500 and invests it like clockwork. The other spends every penny on lifestyle upgrades, latest phone, fancy dinners, clothes for approval. 10 years later, same income bracket, wildly different lives. Why? Because one used money as a tool, the other used it as a bandage. Your money is always talking. The question is, do you listen? Here's a story. A man used to complain he couldn't afford to invest. But every weekend, he bought 2 premium coffees, went out twice for drinks, and paid monthly for 5 streaming platforms he barely used. He wasn't lazy. He was unaware. When he finally tracked his spending, he realized he was investing, just not in anything that paid him back. His money wasn't gone. It had just been silently voting for someone else's wealth. Peter Lynch believed the best investors weren't just market savvy. They were self-aware. They knew their own triggers, their fears, their default settings. Because money is emotional, and every dollar you spend is a decision about what matters to you and what doesn't. Want to know if you're ready to invest? Don't start with your portfolio. Start with your spending history. It will show you. Do you value ownership or convenience? Are you buying identity or utility? Do you chase validation or build security? Are you reacting or planning? Here's a challenge. Open your statements from the last 30 days. For every charge over $20, ask, would I buy this again today? Not to judge, to see. Because when you start seeing your money with clarity, the fog lifts. You stop feeling broke and start feeling in control. Have you ever said, I don't know where my money goes? That's not confusion, that's disconnection. And disconnection is the enemy of wealth. What if, from today on, you treated every dollar like a soldier, every swipe a vote, every recurring charge a permanent habit? Would you still spend the same way? Because before you invest in stocks, you invest in yourself, and the money mirror never lies. Up next, we flip that mirror outward, because your future may not lie ahead, it may lie behind. And in history, you'll find your investing roadmap. Chapter 18, The History of Business. Maizu, your map. You want to know what's coming next? Don't look at predictions, look at patterns. Because every tech boom, every market crash, every revolutionary product, you've seen it before. It just wore a different mask. The railroad became the highway. The telegram became the smartphone. The town crier became TikTok. And through it all, one truth remained. History is not just a record, it's a roadmap. Here's the big idea. If you study how businesses rose and fell across time, you'll stop reacting to chaos and start recognizing cycles. Peter Lynch understood this better than anyone. He didn't need a crystal ball. He used a compass carved by the past. Think about the birth of modern banking. In the 1800s, private banks exploded. Then came regulation, consolidation, expansion. If you were paying attention, you could see the rise of fintech 150 years before anyone called it that. Or consider retail. Sears used to be the king, a catalog empire. Then Walmart came. Lower prices, better logistics. Then Amazon came, even cheaper, even faster. Same pattern, new tools. And what's next? Maybe TikTok storefronts. Maybe AI-driven personal shopping. The names change, but the dance stays the same. Now apply that to investing. Let's say you see a new payment platform in 2025 that teens obsess over. Instead of asking, is this hype? Ask, where have I seen this before? Square, PayPal, Visa. The pattern repeats. And if you can trace the bloodline, you can spot the future. Real example. Lynch made huge gains in mundane industries, tires, groceries, even funeral services, because he knew that new money follows old needs. He'd study how a business model evolved over decades, then find its next iteration. Not sexy, just smart. History also trains your patience. When you understand that markets always correct and always rebound, you stop panicking, you stop timing, you start trusting your strategy. But more than that, history reveals investor psychology. Greed and fear aren't new. They've been moving markets since tulip bulbs and railroad stocks. Once you see that human nature hasn't changed, the news becomes background noise. You recognize euphoria, you recognize despair, and you know both are opportunities. Have you ever looked at a chart and felt anxious but couldn't explain why? That's not intuition, that's ignorance of pattern. What if, from now on, you studied not just companies, but cycles? Because a great investor isn't just betting on businesses. They're reading history. They know the signs, they know the stages. They don't just know what's hot, they know where in the arc it sits. So next time you're tempted to follow the crowd, pause, ask, has this happened before? The answer is almost always yes. And once you read the past fluently, the future stops being foggy. But there's one more map you haven't read yet. You. Because the final business to study is yourself. Chapter 19. The business of you. What if you stopped treating yourself like a person and started treating yourself like a business? Not in the cold corporate sense, but in the strategic, intentional, investor-driven sense. What if your time was capital, your energy was product, your attention was inventory? Because here's the hidden truth. You are already running a business. The question is, are you running it well? The big idea is this. Wealth doesn't begin with money. It begins with how you manage the business of your life. Peter Lynch invested in companies with discipline, vision, and clear direction. But most people live their lives with none of those things. They drift, react, survive, and wonder why they feel broke financially and emotionally. Let's flip that. Picture your life as a startup. What's your product? Your skill? Your mind? Your relationships? How are you marketing it? Your resume? Your content? Your network? Who are your shareholders? Friends, family, mentors, your future self? What's your burn rate? That's your monthly expenses. What's your cash flow? Your income? Is it growing or stagnant? When you see yourself this way, every decision gets sharper. Staying up late watching nonsense? That's a productivity loss. Spending money to impress people you don't like, that's poor marketing. Ignoring your health, that's asset depreciation. Working a job that kills your curiosity, that's an internal culture collapse. Here's a story. A young man wanted to be an investor but had no capital. So he did what Peter Lynch would have respected. He audited himself. He realized he wasted 4 hours a day on distractions. That's 28 hours a week, over 400 hours a year. That's 35 full work weeks. So he flipped the switch, learned a skill, built a portfolio, created value. In 18 months, he had seed capital, not from lottery luck, but by optimizing his own business. This is your turning point. You don't need permission. You don't need funding. You just need to take yourself seriously. When you do, you realize the stock market is just a reflection of what you're already practicing. Delayed gratification, curiosity, pattern recognition, courage. Want to become a better investor? Start by becoming a better CEO of you. Set goals like revenue targets. Set habits like quality control. Hire mentors like you'd hire top-tier advisors. Cut toxic relationships like unprofitable vendors. And most of all, invest in R&D, reading, learning, evolving. Have you ever felt like you're stuck, even though you're doing everything right? Maybe it's because you've been managing someone else's agenda, not your own. What if from now on, you wrote your own annual report, tracked your real growth, cut the losses, doubled down on what works? Would your life look different? Because before you ever touch a stock, you are the first, most important investment you'll ever make. And in our final chapter, we'll unlock the truth most schools, banks, and bosses never wanted you to discover, that your real education starts now. Chapter 20, the school that never existed. They never built this school. There's no diploma, no campus, no morning bell, yet it's the most important education you'll ever get. It teaches freedom, leverage, ownership. It teaches how the world really works, not in theory, in motion. And you've just stepped into its first class. Here's the big idea. The most valuable education isn't found in textbooks. It's found in observing the world, asking better questions, and daring to act. Peter Lynch didn't come from financial royalty. He didn't wait for a license to think. He learned by doing. He watched businesses, listened to customers, followed the clues. And over time, he built one of the greatest investment track records in history. Not because he knew more, but because he noticed more. Most people spend their lives waiting for someone to explain investing in normal language. Waiting for a course, a teacher, an app, a miracle. But the truth is, no one is coming. You are already enrolled in the school that never existed, and life is the classroom. Here's your curriculum. Economics, Stahuan Tuan, go outside, watch what people buy. Psychology, 2-1, observe how people behave when prices rise or fall. Business strategy, 301, study your favorite companies, how they grow, fail, rebound. Finance 401, track your own spending, build a simple portfolio, make your first move. There are no grades, but there are results. You will fail sometimes, pick bad stocks, miss opportunities, but you'll learn. And in learning, you'll build something no traditional education ever offered, financial agency. Not riches overnight, but the ability to choose, to walk away, to build on your terms. Let me tell you a secret. Most wealthy people didn't get rich because they were lucky. They got rich because they stopped waiting for permission. They realized they were already living inside the game. The only difference was, some played, others watched. You've spent this entire journey reading invisible ink, decoding systems that once felt too big, too far, too complicated. Now, you know better. Have you ever wondered why they didn't teach this in school? Maybe it's because empowered people are harder to manipulate. Maybe it's because when you own, you stop obeying. What if, from this day forward, you decided you've graduated? No more financial fog. No more pretending you don't understand. Because you do understand. You've learned to earn. The first share you can't see. You've just finished 20 chapters, not of theory, but of vision. You didn't just learn about stocks. You learned about sight, about systems, about yourself. You've unlocked the skill of seeing money not as a mystery, but as a map. You now understand what Peter Lynch tried to show the world, that anyone with enough attention, curiosity, and courage can become an investor. Let's recap, not as a list, but as a lens. You saw money written in invisible ink, from hamburgers to highways, pantyhose to platforms. You discovered that the best investing advice isn't hidden in spreadsheets. It's hiding in plain sight, in your cart, your habits, your neighborhood. You decoded the game Wall Street plays and realized you were never supposed to win it by their rules. So, you rewrote them. But now comes the real test. Not what you know, but what you do. Will you let this just be a good video? Or will this be your beginning? Here's how you start. Comment below, right now, with the words, "I see the ink." That's your signal, to yourself and to this community, that you've stepped out of the fog. That you're ready to invest, not just in stocks, but in understanding, in vision, in you. Subscribe, because this isn't the end. We're just getting started. We've got deeper dives, real-time case studies, and decoded breakdowns of businesses you walk past every day. And if you ever forget what this journey was about, remember this. Wealth doesn't hide from the poor, it hides from the untrained eye. Now your eyes are open, and the ink is glowing.